Good evening, everybody. My name is Dean Menzies. I'm the partner of Cutcher and Neale Finance. We specialise in both commercial and residential property, and tonight we're going to talk about the property portfolio journey. So at Cutcher and Neale, we provide a holistic approach to growing and protecting our clients' wealth that we call the 7 pillars for success. Finance and cash flow is a key component of the 7 pillars. And tonight is about demonstrating key finance concepts that can help you grow your wealth through property. Over the past 20 years or so that I've worked in finance, I've put together thousands of proposals that have assisted my clients in growing a property portfolio. And tonight I'm also joined by Kylie Frearson, buyer's agent and owner of Property Solutions 101. Kylie has a great eye for a good investment and is an extremely sharp negotiator with years of local real estate knowledge. I've personally benefited from Kylie's expertise with fantastic results in residential and commercial purchases. I'll start the process tonight. So before we get really into it, Cutcher and Neale Finance are very proficient in arranging funding for certain industry specialisations, particularly with doctors, where we can fund up to 95% loan-to-value ratio with no lender's mortgage insurance. The same deal for dentists. We can go up to 90% of the property value for legal professionals. Same with nurses and midwives, and also allied health professionals. Lender's mortgage insurance is a premium that you typically pay to protect the bank's risk, not your own risk, when you borrow more than 80% of a property value. And these professions can go up to high LVRs and not have to worry about that insurance premium, which can cost tens of thousands of dollars. The good news also is that any client of Cutcher and Neale can, at a minimum, borrow up to 85% with no lender's mortgage insurance, which is 5% more than most banks offer. So the good news is, as first home buyers, you do get a pretty good deal if you're going to get your foot into the market. So under the Australian government's first home guarantee scheme, you can borrow up to 95% of a property value up to a purchase price of $900,000 in large regional centres like Newcastle and Wollongong, and large metropolitan cities such as Sydney, Brisbane, Melbourne. There's no lender's mortgage insurance with this deal, so that can save you thousands of dollars. And remember, you only have to come up with your 5%. Now, the first home guarantee in 2024 had 34,000 places available, and there was a choice of 42 lenders that participated in this scheme. So chances are, if you want to participate in this scheme, a funder somewhere that is in the scheme will be able to find a place for you. The way the scheme works is the bank will provide you the full funding, of course, but really their responsibility finishes at 80% loan-to-value ratio, which is typically where mortgage insurance comes in, and the Australian government guarantees that extra 15% to take you to that 95% loan-to-value ratio. So let's look at a first home purchase where you might use this first home guarantee scheme. We'll keep it simple and we use that 900,000 maximum amount of purchase price. So here we have our purchase price of 900K. At that level of purchase, there is some stamp duty even for first home buyers, and the stamp duty in this instance is $20,198. Our legal estimate is $2,500, which is for your conveyancing. So I highly recommend for anybody getting into their first home, one of the things they should do first up is find a good conveyancer or a solicitor. A good conveyancer or solicitor will look at a contract before you jump into an exchange. See if there's anything that's adverse for you personally in that contract before you exchange, and negotiate those aspects with the vendor, solicitor or conveyancer, and hopefully take them out of the contract. So that's a very important thing to note. And also, when you do exchange or when you're about to exchange, that solicitor or conveyancer may also negotiate things like cooling off periods and finance clauses, which can protect you, particularly if the valuation comes in undervalued. So the total cost in this instance is $922,698, and our 95% loan is against the purchase price. So that's $855,000 through the first home guarantee scheme. Personal funds to complete for this purchase, so the total deposit that you require is $67,698 for this transaction. So if we think a little bit further ahead, when we get into this property, we'd be hoping for some capital growth. So if we use growth on an annualized basis of 6%, in 7 years' time, this property value will go from $900,000 to, well, is it really bad here? $1,353,000, is it? So that's a good jump in value. And then by just paying your loan balance on a fortnightly basis over that 7 years, your loan balance will go from $855,000 to $723,000. So you roughly build up around 630K of equity in this property over a 7-year period by just paying down your loan with normal repayments and not going ahead of those repayments, plus getting some capital growth. So we've hopefully got into our first home through the first home guarantee scheme, but what if the property you're purchasing is outside of the scope of that scheme, or perhaps for some reason you can't get a place in that first home guarantee scheme? And that's where the bank of mum and dad or leveraging family support could come in. So through this arrangement, residential equity can be provided by parents or a family member, as well as cash-backed equity. And this can assist you with completing your purchase transaction. You know, at the very extreme end, where the purchaser, perhaps a first home buyer in this case, doesn't have a deposit, you could potentially borrow up to 100% of the purchase price plus your stamp duty costs. One of the things to remember about this type of arrangement, where we're using a family guarantee scheme or family guarantee arrangement, is it does not actually assist with your capacity to borrow more money. When parents or a family member are a guarantor, we're not using their income so you can borrow more funds. What we're using is equity so you can complete a transaction if you don't have sufficient deposit. So what that means is the borrower has to be able to service with their incomes 100% of the debt. So if we look at the graphic here, we've got our first home buyer. The property they're purchasing is $1 million. It's outside the scope of that first home guarantee scheme that the Australian government's got. So we can't use that scheme. As I mentioned earlier, at a minimum, we can allow our clients to borrow up to 85% of the property value. So $850,000 is secured by the property being purchased, and then $150,000 deposit plus stamp duty is being secured by equity in a property that the parents own. That can be an owner-occupied property or an investment property. The parents are left with a limited guarantee, which in this instance adds up to $190,000. And as I mentioned before, the borrower must service the full $1,040,000. So what we'd be trying to achieve if we got you into your home with a parental or family guarantee is that we'd be looking to value the property again in maybe 3 or 4 years. And by that stage, there should be some capital growth and the debt's been reduced. So we'd be looking to reduce the parents as parties to the loan as quickly as possible, really. And then it's all yours as a first home buyer. So this picture resonated with me because it looks like, I think, what my wife and I will look like in about 10 years' time with our kids. But the bank of mum and dad can also be private loan arrangements. So this is where you might have a private loan between parents and the child buying their first home, for instance, or a home, and repayments might be based on an interest rate that's lower than the bank's offering, an interest rate that is equivalent to what the bank's offering, or perhaps even higher. Then you have arrangements where you have perhaps private loans with no repayments, and there could be arrangements made where there's a reduction from the estate, hopefully at a much later date. On occasion, we see cash gifts with no strings attached, which is fantastic if you're the first home buyer. But when these lump sums inevitably arrive in a bank account, some banks will go through the accounts with a fine-tooth comb. They'll see these lump sums, go, where did that come from? The explanation is from the parents. So there might be a declaration required by the bank about what arrangements are being made. So for instance, if there's a private loan with repayments at a certain interest rate, the bank's going to be interested in that, and that can impact your borrowing capacity. So that's a consideration. So at this stage, we talked about getting into our first property through a first home guarantee scheme, even industry specialisation with doctors and other industry specialisations at high loan to value ratios that can get in quite easily, and also leveraging loans and equity from parents. So if there's a way to get into the market, you need to think about, am I best to get in now or should I wait? It might even be a case where a lot of the things we've just discussed you can't access for whatever reason. You do have a deposit, but you may have to pay lender's mortgage insurance, which can cost thousands of dollars. But the question is, if you can get in now, even with a mortgage insurance premium, will there be an opportunity cost? So this is a property that sold in Mayfield in 2012 for $300,000 and sold again after a renovation in March 2019 for $620,000. The estimate at the end of 2023 going into 2024 was $1,050,000. This is a 3-bedder Californian bungalow that's been renovated in Mayfield. So you could see that even with a mortgage insurance premium that might cost you $15,000, $20,000, $25,000 at a high loan to value ratio, if you can't access parental guarantees or the first home guarantees, there could be a greater opportunity cost of not buying that property if you've got to try and wait another 18 months or 2 years to build up a big enough deposit to avoid mortgage insurance. Another thing we hear a lot when we deal with anybody, no matter what their background is, we're after the best rate possible, we're after the cheaper rate. But there might be quite a big difference in borrowing capacity between the best rate and a rate that's higher. And it also might be the difference between you being able to buy, say, a 2-bedroom property or a 3-bedroom property. So the quality of the asset may be a better long-term play than the property you can get with a lower rate loan. And then with the loan that's more expensive, considerations could be made around, well, is there a trade-off that I could make out of my monthly budget, for instance, such as cutting out some takeaway meals or renegotiating with an energy provider, where I could offset that extra cost of the loan to get extra borrowing capacity. So to give you an idea of what I mean, I put some parameters into a calculator we use. We've got a couple, let's say, purchasing their first home with $170,000 of household income, low expenses. And when you put that in, there are 5 funders, mostly no names, that come up before the first major bank. And if you look at First Mac, which is the second on the list in comparison to CBA, the rate with First Mac is 6.64. The CBA rate's 6.27% lower, but the First Mac borrowing capacity at that level is $30,000 higher. Now, $30,000 to some of you may not sound much, but when you're purchasing your first home, that could mean the difference between a 2-bedder or maybe a 3-bedder or a 1-bathroom or a 2-bathroom house. And it could mean, that you don't have to go for the property that's second best in the ones that you're interested in. So that's a thought where, the best rate's not necessarily the best outcome for you when you're trying to get into your house. And remember, once you do get into your home, you can always refinance and renegotiate rates a year or 2 later. So we've talked about getting into our first home. And once we've done that, we need to start thinking of the future and perhaps accelerating to a property portfolio. So I mentioned much earlier in the presentation, capital growth on our first home that we purchased of around 6% per year. And fortuitously, the CoreLogic regional market update landed in my inbox on Monday, which backed up sort of what I had in my head. So Newcastle and Maitland, the capital growth over the last 12 months has been about 6.3% on average. And as we're talking about the property journey tonight, including growing an investment portfolio, it's also interesting to note that rents are up 5.4% to the 12 months through to May and 3.1% in the last quarter alone. So going back to that earlier slide that I showed about purchasing your first home, the purchase price was $900K, total costs $922, almost $923K. We got our 95% loan for that first home guarantee scheme, and we had the required deposit to complete the purchase. But as we mentioned, there was 6% per annum growth, And the value after that period of time was after 7 years was $1,353,000. And our loan balance is now $723,000. So we've got about 630K equity in the property we initially purchased after 7 years by just paying down our debt as normal and with 6% per annum capital growth. So after 7 years, we're looking to upgrade. We want a nicer house. And we also are considering trying to keep our current property as an investment. So what might this look like? So our new property value is 2.2 million. And as mentioned in the previous slide, our current property value is 1,353,000, giving us a combined value of $3.5 million. Now, available equity at 85% loan to value ratio against the two property values with no mortgage insurance, which at this level of transaction would cost an absolute fortune with mortgage insurance, by the way. But at available equity of 85% LVR, $3,020,000 is equity available, and we've got a current home loan of $723,000. Now, that loan is now an investment loan, and it's at a fairly decent level, so that will have some deductible benefit at tax time when you start getting rent on this property. So the total funding available is now $2,297,000, but we've got to account for our stamp duty and fees for the $2.2 million purchase, which is about $104,000. So our funds available to complete after 7 years is $2,193,000, which almost covers our $2.2 million purchase price. Now, I'd be really hoping that after 7 years of paying your loan down, you did occasionally pay your loan ahead of schedule and you might have saved some money in your offset account. So I think in 7 years' time, you can cover your $2.2 million purchase price, subject to borrowing capacity, of course. So that's a tick. You've covered your stamp duty. You've covered your 85% loan to value ratio. There's no lender's mortgage insurance, which at this level of transaction, as I mentioned, would be tens of thousands of dollars. You've now commenced a property portfolio, and you've done this in a time frame of 7 years. 15 years later, you'd be hoping that your career's progressed, household incomes have increased, property values have increased, there's been some debt reduction over time, you've used cross-securitization with the equity in your various properties to your benefit, and at a minimum, you've got 85% loan to value ratio across multiple properties available. So your aspirations are becoming a reality. You started off with your initial first home buyer purchase, you upgraded with the family to a long-term residence a bit later on, which was a $2.2 million purchase. You got, a bit adventurous. You might have dabbled in a little bit of development and built a couple of townhouses, and you like the idea of another property that you saw that you're going to put one of the kids in later on, and you purchased that over time. So you've done really well, and by using cross-securitization, you've managed to build a pretty decent property portfolio. It's a fact I only found out the other day, and it was on a podcast, so I'm not exactly sure if this is 100% true, but only 0.5% of property owners in Australia have 6 or more properties. So you may need to think strategically to scale up to get to this advanced category. And at some stage, borrowing capacity in your personal name starts to be stretched, and that could be after buying 1 investment property or 2 investment properties, not necessarily 4 or 5. So could purchasing a property through a self-managed super fund or even a trust structure with other like-minded people allow you to reach this advanced category of property ownership. So these structures will mean independent legal and financial advice is required, and it is a lot of work and there are costs. But you could put yourself in this advanced category of property owners by considering these strategies, and it could actually mean by using these types of entities or these types of arrangements that you could purchase an investment property that you could run your own business from or practice from through these types of structures which are extremely tax effective as well. So finance is part of your property portfolio journey. it might start off where you on your own or perhaps with a partner buy the initial residence, and then you venture out and add an investment property portfolio. Now, over time, as you have a family and your career and income progresses, there might be the need to set up other entities such as investment companies and family trusts and a self-managed super fund. A self-managed super fund might buy a practice premises or a business premises directly or indirectly through that trust structure I mentioned before. And of course, these types of entities can be used for other asset classes such as equities. So really what my part of tonight's discussion is about is thinking of finance as a tool to grow your wealth in property over time. So just to touch on it, a final, I guess, overview of what can be done for you. We've talked tonight about some of you in the room that can definitely borrow up to 95% loan to value ratio with no lender's mortgage insurance. And we also know that as a worst case scenario, through Cutcher and Neale, you do 85% loan to value ratio with no lender's mortgage insurance. We talked about cross securitization and using equity across multiple properties to help you grow your portfolio. Later on, as your career progresses, you might get advice on debt reallocation and using equity also for business purposes and personal investment purposes outside of property. And there's ways and means outside of just your investment loans to maximise deductible benefit with the right advice. And as you saw tonight, by using finance in the right way with the right structures, you can accelerate to a property portfolio. So I hope you got something out of my discussion tonight. We're going to take questions at the end, Kylie and I. But next up is Kylie from Property Solutions 101. Kylie is a great negotiator, has a great eye for a good bargain, and has years of local real estate agent. So I welcome Kylie to talk to you.
Hello. I was just thinking about what Dean was saying, and this is not financial advice because I'm not in the financial arm, but 4 years ago I purchased a property and I needed to get lender's mortgage insurance, which is about $15,000. And in January I sold that property for $400,000 profit. So sometimes it is the devil, but it's not always a bad thing. As Dean said, my name's Kylie Frearson. I'm the Director of Property Solutions 101. I started a buyer's agency in Newcastle in 2011 after I left a role at 2 large commercial real estate agencies. I did it because I felt buyers weren't represented in the market. They had no independent and nowhere to go when they wanted independent information. Our goal was simple: to save our clients time and money, to remove some stress, and to remove the emotional value in property. Who is listening to the media at the moment with property and all their advice they've got? It's very overwhelming. I read it and I think, oh no, the Australian property market is going to crash. That was the biggest article I read at the start of COVID. They got it wrong. When you're reading the media, don't let it overwhelm you, okay? It's general information and it's not about any particular property. And it's always, you know, you should always afford the property you buy. So if you've got to buy in different markets, everyone buys in different markets, but always make sure the property you buy is affordable. In 1980, the property prices had hit an all-time high, right? There was nowhere to go. All the media was saying the property prices has reached a max. The average property price in 1980 was $76,000. Interest rates were 13%. If we fast forward to 2010, the average Australian property price is $643,000. Property data started being collected around 1951. And as you can see, property prices continue to grow, right? The market's changed. The projection is up, but the markets go up and down. So what I mean by that, in 1990, the average property price was $184,000. Okay, it dropped back in 1995 to 150,000. By the end of the decade, it doubled in price. It was up to 300,000. So the market was going up and down, but the property prices were growing. Interest rates, I mean, that's a topic everywhere at the moment. They were 17% in 1990. In 2000, they were 8%, but the mortgages were double the price. Let's fast forward to today's market. what am I interested in the suburbs I'm interested in? I really like Shortland as a property, as a suburb at the moment. It's 9 minutes away from the John Hunter Hospital. Okay, it's in between the John Hunter and East Maitland. Hunter New England Health is one of our biggest employees in our region. So I really like it for investment stock. But what else I'm seeing out there is a lot of homeowners moving out there. They're renovating properties and they're going to create their own little bubble out there. The average price in Shortland is 660,000. If you look at CoreLogic, you can get up to 800,000 out there. There's different pockets that you need to buy in. I like Cardiff. Cardiff's surrounded by Cameron Park. It's surrounded by Warners Bay and Charlestown. All three suburbs are $1 million suburbs. Cardiff's stuck in the middle and it hasn't performed as well as I would think it has. So I still think there's a lot of growth. What you need to be careful about in Cardiff is high voltage power line. When we were going through the GFC, the banks stopped lending. They would only lend up to 70% if you're within 40 metres of a high voltage power line. I haven't really seen it since the GFC, but if money gets tight, it's something that will come about again. So just don't buy any high voltage power lines. I like New Lambton. I don't think it has increased as much as its surrounding suburbs. And the same goes for Katara. Returns on investments in Newcastle, God, on average, I hate averages and in general, the worst words I know, but you're looking somewhere about 3.5 to 4%. Shortland, you might get up to 4.5. Navigating this market is challenging. In 2021 and 2020, people paid too much for property. What we're seeing now are vendor set prices. So the seller setting the price, not the agent. And we're seeing people trying to recover money from making impulsive decisions back in 2021. So I went and had a look at a house the other day in Cahaba. And as soon as I put up, I was like, oh, I saw this house not long ago. So I went back to the office and I had a look at my file and it sold in 2021. It was on the market for 850,000. At the time, I thought it was worth probably about 900, but because of supply and demand, there was little supply and then demand was high and people were panicking in COVID. Someone paid over $1.1 million for this property. Now it's listed for 1.17 million. It's not worth it. You can find some comparisons in the area that have sold for over 1.2, but they're not real comparisons because they're on different shaped blocks. The qualities of the properties are different. Someone might come and pay it, but that is something that you really need to be cautious of in this market. This is why I don't like the media. You can't talk generally about property, okay? Every property is unique. So when I go and buy a property, if I look at a property at say 1 John Street and there's a property a kilometre away and it's in 1 Smith Street. They're both 3-bedroom houses. They both have 2 bathrooms and they both have 2-car garages. Are they comparable? No, because 1 John Street, each bedroom is 3 by 3 bedroom. In 1 Smith Street, they're 2.7 by 2.7. John Street's got an extra lounge room. John Street's kitchen's been renovated. John Street's bathroom's been renovated. So they're not comparisons. So general information, stay away from it. Look at sales in the area. Spend the time in the market. Look at properties you may not be interested in, but for what they're sold for. Okay? What side of the street it's on? What way is the backyard facing? North-facing backyards sell for more money. Okay? So don't ever look at general information when you're looking at property. You've got to get right down and do a lot of work. Information, knowledge is power. Okay, so you need to do your due diligence when buying a house. You need to research areas because there are better pockets in every suburb. You need to understand power lines. One of the biggest things I'm now looking at is insurance quote. Okay, rising water is an issue. Climate change is an issue, whether we agree with it or not. Insurances are a big issue. Don't look at an insurance quote after you've purchased the house. Do it as a part of your upfront due diligence. There was a property that we had that was insured for it had insurance for $500,000. It was $1,900. 12 months later, when we renewed the insurance went up to $9,000. Okay, this is one of the hot suburbs in Newcastle. So do your insurance quote upfront. If you don't have the time to do the work, use an expert. how to negotiate. Okay, again, knowledge is power. Ask the right questions. Listen to what the agent is telling you. They will tell you what you need to know. When I walk into a house, I say, why are they selling? Have they got somewhere to go? Is this property under probate? Then once you gather all the information, you can use it in negotiation. You can form your offer. So ask the right questions. Also ask the agent what their intention is when they're selling the property. Are they going to do 4 open houses, or is it going to sell this weekend? If they are doing 4 open houses, they're not lying to you. Don't make the first offer. We're not interested in the first one. We're interested in the last one. So ring him every week and make sure he's going to follow through with the 4 open houses, and formulate your offer from the information that he's told you. And whatever you do not tell the agent how much money you have. Okay? Do not tell him what you think the property is worth. Okay? Like we are trying to get information off them, they are trying to get information off us as well. Okay? So now you know how to how to price a property. You know what questions to ask. How do you become the buyer? When you're asking the questions at the open house, is this property in probate? Okay. If the property is in probate, see if they want some income. Rent the house while probate's going through, if you're in a position to it. If they're getting divorced, do they have somewhere to go? Is a longer settlement important to them? Because sometimes it's not all about the money. Asking the right questions, don't make the first offer. Wait for someone else to do it. If the property is worth 800,000, don't offer 700, right? You're annoying the agent. You're not going to buy it for 100,000 below market. The property is worth 800. Start depending on the information they give you, but start somewhere closer to the price you want to buy it at. If you're buying a property at 750 and it's worth 100, you are winning. At 800, you are winning. Understand their goals, negotiate, know how to negotiate, but also understand the sales process. So first you go to Dean, get your finance pre-approved, right? Then you find the house and you figure out what you think it's worth. And now it's time to make an offer. Part of the offer stage is, are they going to give you a 5-day cooling off period? Or are they expecting an unconditional contract? If they are giving you my preferred way of buying it is a 5-day cooling off period with a finance clause. Because once I exchange conditionally, then I'm going to go and get my pest and building report, and then I'm going to conduct more due diligence because the seller cannot take more offers, right? They're locked into me for 5 days. I could wake up and say, I don't really want to buy this property anymore and walk away from the transaction. It will cost me 0.25%. That's going to be about $2,000. What I also can do is get my pest and building report. And, that might tell me that there's some problems with the property I'm buying. It might say it needs a new roof. It might say there's water issues. It might say there's peering issues. Then I can go back and renegotiate, because whatever we discover in that period, the agent has to tell any other buyer. So the 5-day cooling off period is really powerful. If they don't give you a 5-day cooling off period, you still got to do the same due diligence, but do it before you make your first offer. Okay. If I was buying and I couldn't get a 5-day cooling off period, which is, agents will say they never do it. 80% of the property that I buy have a cooling off period. But if they won't give you one, or you're going to auction, do your due diligence before you make an offer. Get the conveyancer to review the contract, get the pest and building report reviewed, talk to the pest and building inspector. I always ring them and say, okay, what am I up for in the first 12 months? And then what am I up for in the next 5 years? Okay. Then use that information to formulate your offer. You might have thought the property was worth 750. Now it's worth 720 to you, because you've got to spend some money on it. Okay. Pre-inspections, don't do them 4 days before settlement, do them the morning of settlement. Whenever you accept the property, so just say you're settling on a Monday and you go and look at it on a Friday. The house gets broken into on a Saturday. That's yours. You've got all those problems. Always do it the morning of. Take your inclusion list. Know what you're buying. So when you buy a property, you've got an inclusion list. Take your inclusion list. And check the hot water, check the oven, check the air conditioning. Make sure there's no rubbish left on the property. Then you ring your solicitor and say, right, I'm ready to settle. Okay. I've covered a lot of topics, big topics here very quickly. And the reason I do it like that is because I want to stimulate conversation with you guys, and you ask me what you need to know. If you have any questions, you can scan the QR code. And other than that, I'm open to questions if you have any. Come on. Yeah, go for it.
Sometimes when you look at purchasing your property, some agents will put the price, some agents will put a contact agent and don't actually put a price at all.
Yep.
And then there's obviously different variations around there. Why would agents choose one over the other, or is there any big differences?
Sometimes they do it because it might be a vendor set price and the price is too high. Sometimes they might do it because they're not sure. So agents only sell what they sell. When we go out and look at properties, we're looking at everyone's property. So sometimes they're unsure on what the market, where the prices are, and that's why they'll do it. To be honest with you, I never look at listing prices. That's white noise. We've got to go and figure out what we think the property's worth, and then it doesn't really matter what they're listing it for, but it could be for a number of those reasons. They like some underquoting is a big issue also in this market today. I went to an auction recently and there was 3 other buyers agents there, and the property was listed at 900. The 3 buyers agents went to 1.1 million. We're all working on the same data. Okay. It's just, there was 14 bidders and only 3 people raised their hand on the day. Okay. It's really expensive for people to go to auction, and so don't look at what they're listing it for. Don't look at their guides. Price it yourself. You've got to, you're spending $500,000 plus. So you've got to spend some serious time in the market and understand what you're buying so you can make good decisions.
Further questions from the floor?
Just to vote.
Yep.
Yeah, yeah.
Yep.
With the mention the borrower has to service the full debt when it's
Family guarantee.
Yeah.
Yep.
What is the how is the other 15% covered? Is the the bank and mum and dad guaranteeing the 15%?
Yeah.
And
So that's right. So in the example that I showed where, and that is the extreme end, because what we're saying is the purchaser can't throw any money at it.
Yeah.
At the extreme end, they could borrow 100% plus costs, and in that example, it was the 150K deposit plus the 40-odd K stamp duty. So the limited guarantee is for about $190,000.
So that's a guarantee provided to who, with principal income, the other one,
Up to the bank.
yeah, the bank.
Yeah. Yep.
Who finance 100%, but they have a guarantee.
But for 15% plus the stamp in that example.
With money ordered to insurance, what the cover?
Covers the bank's risk. So it's basically a premium to protect the bank. So it's got no protection over the buyer. So mortgage insurance kicks in when the borrowing is more than 80% of the property value.
Yes, but what is the risk that's being covered?
Oh, the risk is that the buyer essentially can't afford their repayments, they default, then the bank's got to take control of the property, and that property, because it's just recently been purchased, they might not get rid of it quick, they might lose some money off it. So it's essentially to protect potential bank losses at higher level.
The problem line.
If you're a younger, say a first home buyer, and you're looking for your first property, would you be more looking towards an apartment in a maybe a higher value area in terms of property market, or would you look more towards a property say further out from a CBD in general, that has more land and a house, or does it just depend on different areas?
I'm a big fan of owning the land itself, but that's not to say that apartments can't work for you, and there's been good growth in apartments. It probably comes down to budget based on your borrowing capacity as well, and obviously where you want to live. But even when you buy your first property, to get a lot of the schemes and benefits of those schemes, you only have to be in that property
for 6 consecutive months in the first 12 months or 18 months. So, you know, it could be a case where you get all those benefits done by a property, live in it for 6 months, maybe you can get some people, you know, to rent with you, and then go, no, I don't want to live here, I want to go live in Maryborough, and rent, and then it becomes an investment property, but you've got all those initial benefits. I mean, there's a lot in New South Wales, there's thresholds where, you know, for instance, you don't pay stamp duty. We didn't do that threshold tonight because we don't have the degree that's possible. And one of the reasons I did that is frankly, we're just seeing more and more outcomes from first home buyers where they haven't paid stamp duty because we're not giving the quality asset, at least around here. But if you went west, you might get that asset that works in the threshold for the paying that second.
I would stay where employment is, so I don't know how far out you're talking. So if it's a house in close proximity to our CBD, or if it's out in Muswellbrook, I would probably look at a unit in that scenario. And it depends on how units are performing at the time. So at the moment, I think they're undervalued. I always like land as a preference, but it depends on what your budget is and how far out you have to go to get that house. Yeah.
And what are the current opportunities in terms of government support for first home buyers?
I think the opportunity is good. So, you know, that first home guarantee scheme, which is up to 900K in an area like Newcastle or large regional centres, cities, I think that's a pretty good entry level in most places. You can find a property at that level. So I think that's great. If you buy up to 95% at that level, then in New South Wales, there's thresholds we don't pay stamp duty as well. So, you know, if I look back to when I think I might have got, it might have been 10,000 back in the day when I bought my first place. The actual benefits now are much, much better. And there's also 34,000 places to live. And from my sort of research and looking at different lenders, and there's 42 of them, we don't blow up in all those funders, but those funders are out there, and I would recommend to anybody, if we can't get a place with somebody that we deal with, well, you know, go and speak to somebody quite random like police bank, because chances are they've got places to live and get in there, and then in a few years' time, if you want to buy an investment, if they're looking for you and see what you can do through them. So it's, I think there's lots of opportunities to use those things.
I was a little bit interested in asking you more questions about bank of mum and dad. You know, particularly in a scenario where you might lend, pick a number, I think the number used was 200,000. Let's say if the bank of mum and dad gives you know, the child and the partner 200,000, and there's no repayments to be made against, you know, their inheritance or estate in under 30 years' time or whatever. Now you were mentioning that the $200,000 appears in their bank account. The bank then will ask questions. So is it a reasonable response to say, well, we've been given an early inheritance, there's no repayments to be made against that?
Absolutely, and that means that there's no
That does
Well,
impact on their ability.
Yep.
Yeah, okay. The other thing too is, I guess if you give your child or partner $200,000 towards their first house, the other scenarios that we're sort of a little bit concerned about are two things. You know, one, if there's a marital breakdown, say how you protect your $200,000 with your child. Is there ways that you can write it into that should the marriage break down in previous times, that, you know, that $200,000 has to be paid to you before any, you know, distribution of assets?
Yeah, that's when we would recommend go and speak to a solicitor, and we've got plenty of contacts in that field. Go and have that discussion, probably get something fairly formalised.
And that can be formalised or works. Yeah. The third point is, let's say if they're your child or partner involved in the business, and the business goes belly up, and there might be a claim back against that. You protect your $200,000 from the bankruptcy.
With the children you're talking about?
Yes.
Well, the first thing we'd be trying to do is sell the asset before it goes into default, and before the bank wants to, shut things down, everybody. And then hopefully we can clear, whatever the commitment is. But if there is some commitment left over, so to speak, then you're liable.
I guess it's kind of more or less that, let's say the 200,000 you put in doesn't end up being
Oh, you would take into that business.
taken into that business, and so you can't be a first loan where you get.
No, that would be definitely something where I would sign a contract and, when we look at that contracts, like that would be something that would happen. And I know that, the liquidator would be coming to play, they might not go up, but I don't, in my opinion, they can't go after you.
I'm not so much going up first, but wanting to extract the 200,000 before it goes to some random person who.
Yeah, I think in an instance like that, it's supposed to move real quick. But, I guess they've got an asset that's worth something and liquidators can go after it and you are on looking for some of that.
And you may not necessarily be the first to be paid out. And
Potentially not, but, this probably is where things come down to everyone communicating with each other, and I know when people get in trouble, they don't always do that, but, if it even looked like something was going to happen, but there's a fair chance of it.
Oh, sorry, just a question on tax debt and borrowing capacity. Is it better just to get rid of debt completely before even going to be a broker or starting the process, or it has an effect, a big enough effect to?
It can have a big effect, and then it also may not have a big effect, so that depends on your salary. So you might have quite a big HEX debt, but not all that much is coming out of your pay slip that they can see each month, and they're only going to be looking at, that incremental amount that comes out of the pay slip. But if you're earning, a relatively good salary, that increases, and it will over time knock your borrowing capacity. So it depends. If you've got a deposit for a property and you can get into that property and it all works with the HEX still there, well, that's where you talk to someone like myself. We'll go, well, let's do the calculations, because you don't have to pay out a large lump sum for money yourself for a deposit. Don't, because we can get you in there.
Yeah.
Probably still. Any other, and it's not about the balance. It might be 100,000, might be 50,000. It's about the balance. It's what's coming out of the pay each
Yeah.
fortnight or each month.
It's quite low,
Yeah.
there has been when one can just 10,000, pay it and get rid of it, or be so low, it's like, it's just
It's just those variables between, yep, there's not much of a balance, but is there much coming out of your pay slip? And that's what we look at and go, all right, you've got to work, or it can still work with that. So
Professions, then what about engineering profession?
the which one?
Engineering?
Yeah, there's some funders that will do higher loan to value ratio for engineers as well. I'm sort of, the ones I showed before, the major banks tend to be all over those, especially in those health areas. Another one, funnily enough, are accountants, if you've got a CA or a CPA, where you can go up to 90%, but there's second tier funders, there's one called Grant, they'll look at engineers and IT specialists up to 90%. They charge higher rates than say a major bank, but there's funders out there that you've possibly never heard of that look at engineers. There are potentially some policies around engineers at the majors on a case-by-case basis, which back in the day, I think that 90% threshold could have been met with some of them, but you don't hear too much about that engineering policy with the majors as well, so it might be a case of one of those sort of second tier funders that would look at it.
For one clarification with regards to the beginning of the investment property journey. You put in your presentation about cross-sectorization, so basically cross-collateralizing multiple properties. Can you just expand a little bit more the logic behind it? Because I've been told over the whys and I've done over the whys.
Yeah, so a lot of people we'll go, we don't want to do it, it's still hard to unwind, but it's not a hard to unwind if everything's similar ownership or same ownership. It's pretty simple. If everything's growing in terms of capital growth, you can unwind it. That's the first thing I'd say. When you want to use equity in a property to help you purchase another one, more than anything, it probably starts to get messy. So let's say you've got, I've got a client like, by the way, we've got a lot of investment properties, a heap, and you've got loans everywhere. So he'll come to me and go, I want to do this and that, and I'll go, you need to give me a couple of days, because I've got to look at everything we've done.
Yeah, no.
And how it all fits in, because he doesn't want to look across the field size. So he's probably got, I don't know, 10 loan accounts or 12 loan accounts, and he probably could get it down to 4 or 5. So as much as anything, I think it's why you can still use that equity. You'll end up with a lot more loan accounts.
Yeah, and I always wondering all the complication, like putting up the taxes.
Well, for us as accountants, you know, when that person comes to tax time, someone inevitably is coming to me and we've got good records of it, and they're going, oh, can you just remind me what we did there? I go, yeah, we did that.
Yeah,
And it can be overly complicated. So, look, people go very good for unwind. If the ownership structure is the same, it's not that difficult to unwind.
but then at the same time, if you have like multiple property cross-collateralized between each other, you will have to value all of them if you want to take the equity out.
Oh, yeah, absolutely. I mean,
Okay, so extra cost.
well, not necessarily, because when you do new borrowing with a bank, most of the time, certainly in the residential space, commercial, but usually with commercial, you don't have that cross collateralization depending on the structure. But with residential, you want to increase your funding, the bank generally covers the valuation. So if we put in reforms and say, we want to do an approval in principle to go and buy a new investment property, and we want to see how the equity stacks up in the 2 or 3 properties we already own, well, the bank's going to cover that cost. Because they can see it going to be, hopefully, we're going to be buying that market for not a couple of.
Yeah.
That's residential.
Yeah, talking about.
And if we go to the extreme in property value, there could be a cost. So those, properties in Sydney Harbour, chances are the valuation.
Yeah.
Any other questions?
Yeah, I know it's a moving piece, but the purpose of the property within a superannuation fund.
Yeah.
What's the test?
So high level, the test is you're going to be contributing to self-funded super funds. So let's say it's a couple with a self-funded super fund. Contributions $27,500 each, but they might put in one concessional as well. So if there's a history of that, that can potentially be demonstrated. And then it's going to be what's considered fair market rent from the valuation. So high level, it's contributions at super plus fair market rent then assessed to service the debt. But from time to time, if someone's in an incredibly strong position financially, there are definitely funders in that space that will kind of think that's what the square. But with our medical practitioners in particular, we can go up to 90% loan value ratio through self-managed super funds for practice premises, for example.
Yeah, that's commercial premises.
Yep.
Is residential premises?
Yeah, residential. So if it's purely for investment, 80% loan value ratio. If it's purely for investment in the commercial space, 80%. Same with those unit trust structures I showed you before. If there is any medical practitioner in the room, by the way, that unit trust structure where there's other individuals, you can buy 100% of the property by under that structure. The amount of money you have to put down is 16 figures, which is pretty attractive. Nobody else gets that, by the way. Medical, thank you. All right, well, we might convene and have a bite to eat, and
I think there's a QR code.
yeah, there's a QR code. Hopefully tonight will be informative and you took something out of it. At Cutcher and Neale, we'd love to get some feedback from you if you can do the QR code and Tell us what you think, that's great, and otherwise, we'll be up the back and we're free to answer more questions and I'd like to let the truth of you. Thank you.